You have a job. You pay your bills. You did everything they told you to do, and you are still broke, not poor. Not lazy. Not reckless, broke, and the worst part? You are not alone. You are statistically the norm. Right now, American households are sitting on $18.2 trillion in debt. Not the government. Not Wall Street. Ordinary people. Teachers. Nurses. Engineers. People who make decent money and cannot figure out why none of it stays. Here is the number that should stop you cold. Nearly half of middle-class Americans, people earning between $50,000 and $100,000 a year, cannot cover a $500 emergency without going into debt. $500, one car repair, one ER visit, one broken water heater, and half the middle class cannot absorb it without borrowing money. This is not a poverty story. This is not about people who made bad choices. This is about a system that quietly, methodically, made it mathematically impossible for normal people to get ahead, no matter how hard they worked. I am going to show you exactly how it happened. 5 specific mechanisms. In order. And by the end of this, you will understand why you feel behind even when you are doing everything right. Here is what nobody is saying loud enough: credit card delinquencies, people who cannot make their minimum payments, are now at a 13-year high. The last time it was this bad was 2008. The year the entire financial system collapsed. We are not there yet. But the math is pointing somewhere ugly. So how did a country full of working, earning, bill-paying people end up here? 5 wounds. All bleeding at the same time. Wages flatlined. Real wages for middle-income workers grew less than 0.5% per year over the last decade. Meanwhile, the cost of living jumped 33% between 2015 and 2025. That is not a gap. That is a canyon. You worked harder every single year, and every single year you could afford less. The math was broken before you even started. Housing became a trap. Median home price in America right now is $414,000. Average rent in smaller cities is $1,800 a month. Big cities, $3,000 or more. Housing is now eating 40 to 50% of take-home pay for millions of middle-class families. Financial advisors say 30% is the maximum safe limit. The system made 30% a fantasy. Healthcare became a gamble. The average annual premium for employer-sponsored family health insurance is $24,000 a year. Before your deductible. Before co-pays. Before what insurance quietly refuses to cover. One accident. One diagnosis. One hospital stay. A family that was barely keeping up is now financially destroyed. People are skipping doctor visits and rationing medication. In the wealthiest country on earth, student loans became a life sentence. 43 million Americans owe $1.7 trillion in student loans. Average borrower carries $37,850 in debt at 6.5% federal interest. Private loans go up to 17%. They were told a degree was the ticket to the middle class. It became the price of admission, with compounding interest attached. And before you think this is a young person's problem, over 3 million Americans above the age of 60 are still paying off student loans. Still paying, and then the 5th wound: debt became the only option left. When your paycheck does not cover your life, you do not starve. You swipe. Credit cards. Buy now, pay later. Home equity loans. Debt became the scaffolding holding up a lifestyle that a normal salary should have covered without any borrowing at all. The average new car now costs $47,000. Auto loans are stretching to 84 months, 7 years, just to make the monthly payment look manageable. While you pay thousands extra in interest on something losing value every single day you own it. The middle class did not get reckless. Life got unaffordable. And debt became the only bridge left standing. Now let's talk about who this is actually hitting, because it is not who most people assume. if you are between 30 and 59 years old, you are statistically the most exposed person to everything just described. This generation got hit from every direction at once. Student loans when tuition was already exploding. Entered the job market during recessions. Tried to buy homes when prices were already out of reach. Raised families during the highest inflation in 40 years. Many started adult life underwater and never once came up for air. Here is the number that breaks people when they hear it. The median retirement savings for working-age American families, according to the National Institute on Retirement Security, is $0. Not a little. Not almost nothing. Zero. The most common retirement savings balance for a working American family is nothing at all. And Americans approaching retirement face an average $75,000 shortfall versus what they actually need to survive. These are not irresponsible people. These are people who kept paying into a system that kept raising the price, and here is the part that genuinely shocks people. Households earning $100,000 a year are living paycheck to paycheck in high-cost cities. After taxes, mortgage, childcare averaging $15,000 per child per year, health insurance, and student loans, there is nothing left. The average debt-to-income ratio for middle-class households is 43%. Every financial expert agrees the danger zone starts at 36%. The average American family blew past the danger zone and kept going. The wealthiest households in America now control 48% of all national wealth. In 1970 that number was 29%. While the middle class got squeezed tighter every single decade, wealth at the very top got quietly, enormously larger. So where does this go from here? Credit card defaults are accelerating. When people cannot make minimum payments, banks cut credit limits and spike interest rates. More borrowing. Worse terms. It is not a temporary dip, it is a spiral. And it is already spinning. The housing market is frozen. Rates high. Prices unmoved. Homeownership, the single most powerful wealth-building tool the middle class ever had, drifting further out of reach every quarter. Student loan relief is being dismantled. Forgiveness programs cut. Protections rolled back. For 43 million borrowers, the small light at the end of the tunnel just got smaller, and Social Security trust funds are projected to hit insolvency by 2033. Medicare by 2030. The safety nets the middle class paid into their entire careers are beginning to crack. So what do you actually do right now? Understand first what this actually is. This is not a personal failure. This is a structural trap. Blaming yourself for being underwater when wages, housing, healthcare, and debt are all pulling you down simultaneously is like blaming yourself for getting wet in a flood. The people who survive this are the ones who see it clearly and move with urgency. Eliminate high-interest debt first, completely and aggressively before anything else. Stop financing lifestyle on credit, cars, vacations, appliances, all of it. Build a $1,000 emergency wall before you put a single dollar into anything else. The middle class is not broke because it was careless. The middle class is broke because the cost of being middle class quietly became more than the middle class actually earns, and until the wages, the housing, the healthcare, and the debt structure fundamentally change, the water keeps rising. If this video made something click for you, share it with one person who needs to hear it. Not for the views. Because they actually need to hear it.